I'm a 14-year-old investor, and I beat 94% of Wall Street's expertly managed funds every single year, and you can too. How is that even possible, you ask? Well, all these funds make one crucial mistake that leads to their downfall. I'll show you how I avoided this deadly trap to beat Wall Street and how you can replicate my success for free in just 5 minutes. First, let's take a look at what all these Wall Street funds do and where they're going wrong. These actively managed funds have a team of experts who try to find the investments that they think will give the highest returns. The people running the funds are professionals, so you'd think they know exactly what to invest in to make a huge profit. But that's where you're wrong. In practice, these funds don't actually do that well. But why? To figure that out, we have to go back to 2016 when my investing journey began. I started investing when I turned 7 by putting my entire allowance into the stock market. Since I was really new to the world of investing, I invested in individual blue chip stocks that I thought would do well, just like Wall Street funds. If that's what the experts were doing, I thought it would work for me too. But over the next couple of years, I learned a lot more about investing. That's when I uncovered the truth. There was one investment that would catapult me to success, far greater success than even Wall Street was able to achieve. What was this incredible investment? Index funds. Index funds track a certain stock index, like the S&P 500. This means they invest in the same stocks in the same proportion as the broad-based index they're tracking, allowing them to match the overall stock market's returns. The trap Wall Street's actively managed funds fall into is trying to beat the market. Even if they do succeed, it'll only be for 1 or 2 years, as the data proves that it's impossible to beat the market consistently over the long term. Instead, by investing in index funds, I have been matching the market's returns, which is actually higher than 94% of Wall Street's actively managed funds. You can beat Wall Street too just by investing in index funds. Let me give you an example to show just how well you can beat Wall Street's professionally managed funds. Let's say John invests $100 a month in an actively managed mutual fund returning 9% per year from the time he's 20 to his retirement at 65. The fund has a 0.6% expense ratio, which is about average. By the time John retires, he would have $520,000. This seems like a great return, but is it though? Let's find out. Sally invests the same amount as John for the same amount of time, but instead of an actively managed mutual fund, she chooses a broad-based index fund that tracks the S&P 500. It gives an average return of 11% per year and has a 0.05% expense ratio. So even after investing the same amount, Sally would have twice as much money as John, over $1.15 million. And this just goes to show how you and I can significantly outperform Wall Street by simply investing in index funds. But knowing what to invest in is just the beginning. It doesn't even matter if you don't actually start investing. Watch the video on your screen to learn how to start investing quickly and easily.